Up, everybody? Ty Crandall here, and we are going to be jumping in today, talking a little bit more about financing. It has been a crazy time here at Credit Suite. We are rapidly changing a lot of what we're doing in our finance division. If you didn't attend last week's webinar, I recommend you go to the back office and check it out because we went through a bunch of the new changes. I just got out of a meeting with our finance team, and it's been kind of crazy. We've got Jesse with us. Dave has been with us for a while, working in a few different roles. He's jumping onto financing, so a lot's happening. Those guys are getting up to speed. We've 10x'd the amount of communication we have with our partners and with our customers regarding financing deals. We're doing a lot more deals. We're attracting a lot more lenders, bunch of new loan programs, et cetera, et cetera. All of it being designed to make it even easier for you to make money in 2017. Our goal is to really be able to give you a platform where you can make a lot of money on business loans, where we can help a lot more people than what we've even been able to help in the past get business loans, and offer those people a lot of different types of loans, and especially really getting good at specializing in areas where other people just can't help. Maybe they qualify for revenue lending, but then they don't qualify for A, B, C, D reason. Nobody else can help them, where we're able to come in and help in those scenarios. So along this path, we have a lot more loan products that we're adding, a lot more lenders. And at the same time, we also have a lot of our existing loan products that you should know about. So it's been about 4 or 5 months since we've went over our funding programs. I wanted to go through all of our funding programs, not all, but our core programs today, to give you a good idea of what they are, how they work, what the qualifications are, how much money you can make as part of direct funding. If you're in direct funding now, fantastic. If you're not, email dave@creditsuite.com. That's dave@creditsuite.com. He'll talk to you about getting you in. We've got something going on through the end of January where you can jump in. Won't cost you anything to be able to jump in. So this is exactly what a customer can get regarding actual financing. So you know exactly what a customer can actually qualify for. So can your customers get a business loan? How to quickly and easily qualify your clients for financing? Let's dive in, check these out. So I always say the easiest way to know if somebody can get a business loan or not get a business loan really comes down to what I call the 3 C's of lending. So it comes down to cash flow, it comes down to credit, or it comes down to collateral. If you're talking about a bank loan, then somebody needs all 3 of these. And if this is just a repeat for you, that's okay. You can never hear this enough. We go over this still with our sales team and finance team ongoing, and you'll get to plenty of new stuff as well as we get in here. So cash flow, do they have cash flow, consistent cash flow in their business where regular deposits are going into their bank account? Do they have good personal credit? Do they have some type of collateral? For an SBA loan, they're going to require all 3 of these. If you're dealing with a lot of the loans that we deal with through alternative lenders, they're only going to need 1 of these. And if they have none of these, then it's obviously going to be a business credit deal is how that's going to work out. So cash flow financing, there's a couple different ways you could qualify somebody. First is using bank statements to qualify them, and that would open up what are called revenue financing or merchant advances. We don't do many merchant advances. Merchant advances really have to do where they only look at the deposits in your bank account from your credit card transactions, and they usually make you change merchant accounts as part of the deal. We don't like either one of those, so we typically go with revenue financing, which is where they look at the total amount of deposits in your bank account, and then as well, they don't make you change merchant accounts. The other type of financing available based on cash flow is if you use your tax returns. And this is where we've got a lot more going on than we ever have before, because there's all these loans that I personally call alternative SBA loans. And I'm not saying that's necessarily what everybody calls them. Everybody has a different name. But I call them alternative SBA because they have longer loan terms. They have lower rates. They're very comparable in terms to SBA loans, but they don't have nearly the income document requirements that an SBA loan would actually have. So in this deal, if you've got somebody that has good tax returns to verify their cash flow, there's a good chance they can qualify for an alternative SBA loan, or maybe if they're good all the way around, they maybe even qualify for an actual SBA loan. They may actually qualify for private money. But to be honest with you, there's not a big difference between private money and alternative SBA. The biggest difference is private money comes from investors and alternative SBA comes from institutions. It comes from basically banks. And again, this is my own terminology. This is kind of what we found in an easy way to summarize this. So if somebody's got tax returns, they can get alternative SBA from a bank that's not a big bank. They can get an SBA loan from a big bank. We can help them through that process. Or they can also get private money with long-term low rates available for private investors. So let's look at the first two of these. Revenue merchant cash advances. This is simple money. It's fast and easy money. Can be secured in 3 to 7 days. Sounds crazy, but it's not. We funded multiple deals where we get people money within 24 hours of when they applied. How fast deals close depend on how fast your customer and you are to get us income documents. So if our finance officer and processing team is able to work directly with your customer, it goes pretty fast because they're calling the customer, they're engaging, they're emailing, they're getting what they need directly from the customer. Again, if you put yourself in the middle between the customer and the financing team, that slows things down tremendously and sometimes creates resistance where we're not able to get what we need. But typically, as soon as we get bank statements in, we can fund a deal within a day, sometimes no more than 3 to 7 days. It's easy money. They don't need a good credit. As a matter of fact, nowadays, with a lot of these loan programs, they won't even, if the bank statements look good, and I'll kind of walk through and teach you what bank statements looking good means, they're not even going to pull the credit at all. We see $50,000, $100,000 plus deals happening without a credit check now all the time, which is cool because it doesn't put inquiry on their credit report. And they don't need any kind of collateral to secure this kind of financing. All that's needed is 6 months worth of bank statements. And we're looking for stability. We're looking for constant deposits. So we're looking to have about 6 deposits or more per month. We're looking for stability. People that are not overdrawing their account with less than 3 non-sufficient funds in a month. Somebody that has a positive ending balance on their bank account. If they're managing their bank account and they've got good consistent deposits, then there's a good chance they can qualify for. How much can they qualify for? Well, about 12% of their annual revenue. I like to round it down and say 10% because it's an even easy number to remember. So if somebody tells me they do $200,000 a year in revenue, 10% of 200,000 is 20 grand. So I know they're going to get about 20, 25 grand approximately. So if somebody comes in and says they want $500,000 in financing and they only do $200,000 a year in revenue, I already know there's a problem. We could probably help them get financing, but their expectations are unreasonable. And that's okay. Most people want more than they actually can qualify for. How much somebody can get is about 12% of their annual revenue. It says daily paybacks, but as I left a note here, sometimes weekly or monthly paybacks are also available with lower risk. So we have a deal right now that's working, and I'll tell you what it is. The company is a mortuary, and they got our finance team on the phone and our partner, and our finance team said we can help you with a daily payback. Now, what this means is it means payments are deducted from their bank account daily versus weekly or monthly. Monthly is very rare. Some lenders and more lenders are starting to do weekly. Everybody in the space does daily. So this mortuary right now we're working. They come in. The partner's like, "Hey, look, they need we want daily paybacks," is what the customer said, and it was tough to get the deal done because of some other risk factors. So talk to the customer. The customer said, "Look, I only want this if I could get a monthly payback, a payback once a month instead of every day out of my bank account." So we went to work and we found a lender that would do the deal. We just got him approved for like $67,000 in financing based on a monthly payback, one-time payment a month. Now, this is the beautiful thing. If we would have went to On Deck or one of the other major players in the space, they would not have done it. They only would have done daily, best case weekly. But because we deal with so many lenders and we're adding more of these niche kind of lenders, we were able to get this guy approved for monthly paybacks. And this is a big change that we're making now. We're now acquiring a massive lender list, which we've never done before until starting this month, of banks that will do this off-the-wall stuff. Okay, so this guy wanted monthly paybacks. We happen to now have a list of people that will do monthly paybacks or weekly paybacks, or we've got another one where they need financing and they're in the pot industry and they need commercial real estate or borrow against commercial real estate. We just got that deal pre-approved today from a lender. So because of these new lenders and channels, it allows us to open up some of these sometimes weekly or monthly payback options are now available. Short-term loans, these are about 6 to 18 months. They're typically about 3 to 18 months. But again, now we have some lenders that will go out as far as 3 years. So all of a sudden, not only is this faster, easy money, but now we're starting to get loan terms on some of this financing that's actually competing with term loans. Usually in the beginning, they're going to get shorter terms, 3 to 9 months. As they prove themselves and maybe get 1 or 2 of these, then we can typically get 9 to 18 months or even longer for lower risk. Or second advances. So we can also do second advances. So let's say somebody already has a revenue lending deal. They need another $30,000. We can then start getting them now seconds behind their first to get them a second advance on top of what they have. Or we can go the opposite way. So we've got a guy right now. Listen, this is mind-blowing. You won't believe what I'm about to tell you. The guy is paying $6,000 a day on his merchant cash advances. You heard me right. $6,000 every day, Monday through Friday, is deducted from this guy's bank account. You talk about a guy that loves weekends. This guy loves weekends, right? Saturday and Sunday is the only day he doesn't have $6,000 withdrawn from his bank account. So what we're doing with this guy is we're helping him condense 4 merchant cash advances into 1 and saving them, ridiculous amounts of money. So it goes both ways. We can help somebody now get long-term. We can help somebody come in and we can get a second advance behind their first advance. We can even consolidate multiple merchant advances, which is very hard to do because of the new lenders that we're adding in to actually condense them into 1 and substantially lower somebody's payment. With this financing, they're typically going to get approved for up to $500,000. And yes, we have done deals up to $500,000. And yes, the partner was very happy with the paycheck they received on that. And about over 70% of these come back for more money. Guys, this is what's really cool about direct funding program is that let's say a guy comes in and gets a $100,000 deal and you get paid $3,000 because he got $100,000. Well, statistically, over 70% of those customers come back in 3 to 6 months and say, I want more money. When they come back and get more money, you then get paid on that deal. As long as you're in direct funding, you continue to get paid. So we've got people that have funded now 10 times, and the partner that brought them in at the beginning is still getting paid at thousands of dollars every single time they come in and get more money. And this is very common because, again, over 70% of these people do come back in 3 or 6 and get more money. Do you know why that is? Because it's like super easy. All the lender says is they want the most recent bank statement. So what happens is, let's say somebody borrowed $500,000. When they pay half of this back, which is $250,000, when they get to half, $250,000 paid back, then the lender says, do you want more? And they say, yeah, I want more. Well, we'll give you a longer term so their payments don't go up very much to get a lot more money because the term gets longer. And so because it's so easy for them to get more money when they pay half back, typically most of them will come and will get more money about halfway through. About 70% of the time this happens. The rates are all over the board, 10 to 45%. So risk factors include time in business, the industry they're in, their credit quality, if credit's pulled, the bank statement management, the ending balances. So that's the bottom line. I've seen rates as low as 8% on merchant cash advances. What happened? Somebody said, pull my credit. It's ridiculously awesome. And it was awesome. Their bank account was managed great. They had tons of deposits. They had positive ending balances. They had lots of money in their account all the time. So because of that, they were very low risk and got very, very, very low rates. So even though the mentality on this is that the rates are very high, 40, 50%, they often are on high risk deals. That's the beauty of it, is that people that usually never could have got money before can now get money within days time. And again, statistically, over 90% of these deals are paid back. So the people are able to pay it back and get easy ways to get more and more money when they never could have before. The people that are low risk can get this kind of money still get pretty low rates on it and still get fast and easy money with lower rates. So again, it all depends on risk. How long has this business been open? 2 years or 20 years? Is it, do they have positive ending bank balances of $500 at the end of each month or $50,000 at the end of each month? All these things determine rates. Risk really, rates are all over the board. Everything they pay is 100% tax deductible. So any interest they pay, no matter whether it's 10% or 50%, they get back as a write-off at the end of the year anyway. So it's really just a matter of what makes sense to them, what can they afford. They can't be in trouble as having a bankruptcy or very recent liens, but in a lot of cases, if they have good bank account account management, it won't matter because no bank and no credit reports pulled anyways. They've got to have over 120,000 a year or more in revenue. That comes down to 10,000 a month or more. Okay, now again, we've got more lenders now that will do it if they're less than 10 grand, that will do it if they're less than 1 year in business, but they've got to have some other kind of compensating factor. So let's say they've been in business for 12 years and they only have 7,000 a month in revenue. Well, the fact that they've been in business 12 years is a compensating factor. So maybe we can get that guy that has 6 or 7,000 in revenue approved. So even if they're just shy of 10, there is a possibility if they have compensating factors, they can get approved. The same with time in business. Lenders want 12 months of business. We have a lot of lenders that will go as low as 6 months in business if they have some kind of compensating factor. Okay, and I said here with compensating factors, banks can go down to 5K monthly. That's the same as before. It's supposed to say can go down to 6 months in business. So preferred is 10,000 a month in revenue, 12 months in business. If they are short of one of these, it's okay as long as they've got some other kind of compensating factor. 6 deposits monthly, less than 10 non-sufficient funds a month. Actually, we can get this done it depends. Again, it depends. How many deposits do they have? They might have 10 non-sufficient funds, so they have 200 deposits, or they have 12. So those type of things are into it. But 6 months, 6 deposits monthly, less than 10 non-sufficient funds, positive ending bank balance at the end of the month. Guys, this is important. In this kind of financing, they're getting money only based on the fact that they've got a bunch of money consistently going through their bank account. If they don't have any money left over at the end of each month, well, then they're not going to have enough money left over to pay a loan. That makes sense. So they've got to have some kind of positive ending bank balances to show the bank that they're going to have the money in the bank account for them to actually take. And this deal can pay you 3 points. So on a $100,000 deal, you can make $3,000. On a $250,000 deal, you can make like $7,500. Sometimes it's more. We even have deals where the bank pays us more, and maybe you're able to make 4 points on the deal. So we've done a $250,000 deal, I'm not sure when, a couple months ago, where I saw the commission paid $10,000 to the affiliate. So how sweet is that? They brought in a deal, the deal funded quick, the customer got $250,000, the partner got $10,000 ACH'd into their account, and now the customer will probably renew every 3 to 6 months. And even though the partner won't get 10 grand the next time, because we won't always get paid that much, the partner could very easily make $3,000 to $6,000 or more when that customer comes back and renews 3 to 6 months down the road. Pretty cool way to make money, considering the person doesn't have to pay us a dime and shouldn't pay you a dime. We get them the money, the lender pays us. It's that simple. So with none of this financing, the customer has to pay any money out of pocket. All of this is available. And with that kind of money in hand, 250 grand, it opens up an opportunity for you guys to obviously be able to sell more finance suites as well, which is sweet. Okay, so alternative SBA loans. Funds come from private investors or alternative lenders, which are non-conventional banks. No collateral is required for this kind of financing. They can get loans of 50 grand up to about $500,000. $500,000 are available with longer closing time. So we can get them over $500,000, but it'll take a little bit longer to actually get that deal closed. Nonprofits can qualify as well. Okay, we've got one of these deals right now that's a church deal closing to give you an idea of how much money you could be made. And again, please understand this is not a typical scenario. We've got a deal funding, I think, in about 2 weeks, and the funding amounts in the millions. Our cut is going to be $156,000 is what we're getting paid. And on those deals, we split that with the partner. So the partner will literally have over a $75,000 paycheck on this deal. But again, this took longer to close. The customer went through a lot of due diligence. These deals have to make sense at that kind of loan amount. So it did make sense. It took us months to get the deal done. These are nonprofits that we're getting closed, and the partner is going to make a heck of a lot of money. So what happens is, because these deals can pay so much, a lot of partners get caught up and go, man, I'm only going to seek people out that have $1 million plus loans. But guys, these are the hardest deals to close. If you really want to be successful in the direct funding space, you should be doing any numerous different things. You should be working a lot of revenue lending deals and unsecured deals you're going to learn about. And some of these on top of it, knowing that only a smaller percentage will close, but when they do close, as part of direct funding, you're going to have a pretty big payday. 2 to 4 year loan terms, typically 8 to 25% rates, depending on risk. Okay, we're looking mostly at high profit margins. So we're looking at tax returns to see what kind of profits they actually have. They need to have good credit scores as well, most of the time with this kind of financing. So they basically need good credit and financials for this to get approved. More options are becoming available without tax returns as well. So we've now got some lenders, for example, that will look at it even if the person doesn't have good credit and they have tax returns, or maybe they have good credit, but they don't have tax returns. So we've got some more of these type of options popping up. We've got this new lender that does some cool stuff with peer lending. So like if the customer has like 5% of the money that they can get down from somebody they know, then what happens is at that point they can get the rest from the lender. So the lender says, okay, look, you can come in, you can get money at a 640 score with good terms. You just need 5% to come from a peer or someone you know. Well, that's not a big deal. At a $100,000 deal, that's $5,000. So they get somebody they know to throw in 5, and then they're able to get the other $95,000 from the lender, even with a 640 score. So we've got more of these type of scenarios coming in. What I'm telling you with good tax returns and good credit is the norm, but we've got more and more lenders that are coming in and doing exceptions. You could usually earn about 0.5% on this. We usually get paid 1%, which, like I said, in this case is still enough to pay, a lot of money. So again, what's happening is you're getting paid half of what we get paid on these deals, guys. That's how this works. So alternative SBA venture capital, I say you get paid about 0.5%. It could be more, depends on what we get paid. But typically we're only paid about 1% on these deals, sometimes 2%, but the loan amounts are like ridiculously higher. So the loan amounts are usually much higher, and that results in a higher payout, even though there's a longer underwriting time. Of course, SBA loans we can help them get, but they've got to have 2 years personal and business financials, 2 years personal and business tax returns, 780 plus scores. SBA says 620, but we've seen them deny 780. So they really don't want any derogatory items on the credit report. They need to have positive financials, tax returns that show increasing revenues and profits year to year. Collateral for about 50% of what's being borrowed can be business collateral, their home, etc. And these deals pay you again about 0.5 point. Not very many of these deals you're ever going to see get done. And the reason is because you and we're just not dealing with this kind of customer. We're just not usually dealing with somebody that's got 800 credit scores, 5 years in business, $10 million in revenue. Those guys are typically going to their banks. And to be quite honest with you, their bank's going to usually give them a better deal. And the reason for that is because their bank wants their deposits. So anytime you're dealing with a bank loan, and this is one kind of loan where we easily can get beat, because what happens is banks will undercut their own fees just to get the deal because they want that person to keep their deposits there. So let's say, for example, you go in at the Wells Fargo, you have a $10 million a year revenue business, and you qualify for an SBA loan versus a private, somebody that's going to help you like us on an SBA loan. Typically, the bank's going to give better terms on an SBA loan because the bank wants to keep that person's business and keep all their deposits. So they'll do some crazy things. So SBA loans, quite honestly, the person's probably better if they go directly to their bank. We're not afraid to tell customers that. But very few of the customers we ever see, less than 0.5% of all deals we ever see would even qualify for an SBA loan. 99.5% wouldn't. So this isn't something you're going to see a lot of times. Credit lines, almost everybody wants a credit line. To get a true credit line, though, someone typically has to have good credit, and they also need to have a good tax returns, typically. But again, a lot of things are changing on this. Okay, we just brought in like an average credit line if they've got a good business. We've got a new credit line, which is flipping awesome, where somebody can get a $30,000 line of credit just because the lender, because they have an accounting software the lender reviews, and within an hour we get an approval. So let me give you an example. We use Xero. We tried this out to see how it worked. So we have Xero as our accounting software. We gave them access to our accounting software. In less than an hour, they came back and they approved us for a line of credit. Now, what they're looking for is receivables. They're looking to see if there's account receivables, but they use the account receivables as collateral and get somebody a credit line. We have credit lines that are based on inventory. We have a revenue lending lender that's got us part of a beta test where when they give somebody a revenue lending deal for like 50 grand, they'll also give the person an additional additional $20,000 credit line. So even though the norm on this has always been that you've got to have tax returns and good credit to qualify, it's worth running it by our team because nowadays we've got revenue lending credit lines, we've got inventory-based credit lines, we've got account receivable-based credit lines. All this stuff is coming onto the scenes, and we've really got our ear to the ground to pull the stuff out as soon as it comes in. So the collateral and net profits per their tax returns the last 2 years has in the past always determined their approval amount. If they've got inventory or AR or something like that, then the amount of that is going to determine the credit line. But if they're just using tax returns and good credit, what the lender's often going to do is look at their net profit and use the net profit to determine how much they're going to get approved. Credit-based financing, there's two different kinds. This is called unsecured financing. We also call it unsecured business financing. You also see it listed elsewhere as 0% of financing. And there's two different kinds of financing here. Somebody that's got good credit scores of 700 plus can get the 0% business credit cards that report to the business credit reporting agencies. Somebody that gets 670 to 700 scores usually can only get personal credit cards. They can get a multitude of personal credit cards that report to the personal credit card reporting agencies. So on the personal cards, they get about 10 to 150,000 is how much they can get in funding. They're usually getting about 5 times the amount. This is actually the same with both business and personal. So let me just say these are the same requirements for both, and I'll tell you when it becomes different. So they can usually get up to 150 grand. Yes, we see people over $100,000 on these deals, actually quite often. And they can usually get 5 times the amount of their highest credit limit account. So if their highest credit limit account is 20 grand, they can get 5 times that, which is going to be about 100 grand. So they're typically going to get about Anthony, that was you. He's ecstatic. Anthony just chimed in. Yeah, that was you. That was the mortuary guy, I think, right? So that's cool. So we're working on that. I think he's in the Bahamas. Tell him to cancel his vacation and get back here so we can get that deal done. So approval amounts equal to 5 times the amount of what their highest credit limit account is. So if they have a credit card now for 20 grand, then they could typically get up to about 100 grand. 5 different cards is how that works. Consumer credit reporting. These accounts report to the consumer reporting agencies. I'm going to tell you about ones that report to business in a second. They usually get about 5 business or personal credit cards. This is business, actually personal with the personal credit card program, and it creates competition. So if they get 5 credit cards, then it makes it easier for them to get their limits raised on those cards because the other creditors want their business. And typically we tend to use the credit card with the highest limit. 0% interest rate for 6 to 18 months. Normal rates of 5 to 25% after that. You commonly see these advertised as 0% financing. I'm not big on these being advertised as 0% financing because it's an intro rate. It's only good for 6 to 18 months. It's not like they're permanently at 0%, although some advertise that as if they are. So it's 0% interest rate for 6 to 18 months. Then it's just normal credit card rates. You know, credit card rates are all over the board, right? Some are 5, some are 20%. So it depends on the cards they actually end up getting. Unsecured personal cards, same thing, 8 to 12% fee. On this, about 9.9, about 10% is about average. They'll need good credit, 670 to 700 range. They need to have utilization under 50%. These are more forgiving than the business cards you're about to learn about. So with the business cards, you need to be about under 30% utilization. So if we got somebody that almost qualifies for the next program I'm going to show you but doesn't, that's when this program comes in because they could get 50% utilization, 8 inquiries on their credit report in the last 6 months. This is really one of the best ways that somebody with no cash flow or collateral, especially as a startup, can get financing. It's really, really, really a good program for startups and for real estate agents. And this could pay you 2 to 3 points. Depending on how much you want the customer to be charged, you could tell us. Do you want the customer to be charged 8%, 9%, 10%, 11%, 12%? The way that this works is that the lender has a 60-40 split with us, I think is how that works. And I don't remember if we're on the 60 side or the 40 side, but let's say we're on the 60 side. Then basically we get 60% or whatever the total fee is. We split that with you. Even 50-50, whatever it is. So remember, the purpose of direct funding, guys, is that you bring these people in, our team does the work, and you bring the person in, give them an idea what they may qualify for, get their income docs submitted, and we talked about how to do all that last week. And then we do all the rest. We take the customer, we contact the customer, we do all the aspects of going through the terms with them, getting it done with the lender, getting it placed, getting it approved, going through the terms of the customer, closing the deal, and then we're basically splitting the fee with you. And what happens, and Anthony chimed in and said that one guy was his guy. So for example, if his customer closed today, then basically Friday, Anthony would get a check for that, 2 to 3%. Whatever we get paid and funded, then you get paid that Friday, and we pay it right through ACH into your bank account. So this pays about 2 to 3%. Now, business cards are much the same. 10 to 150,000. Limits are based on about 5% of whatever their highest credit limit account is now. But these accounts report to the business credit reporting agencies. So these build business credit. Wow, they're actually getting money. I love this program. It's one of my favorite programs we have because I like business credit, obviously. Love business credit. So in this case, what we're doing is we're getting somebody money, even as a startup, 150,000 bucks. And then on top of that, we're also then getting them accounts that report to the business credit reporting agencies. So you know how they usually have to get those 5 vendor accounts? Well, they don't necessarily have to do that here, because what happens is they come in and they actually get, their accounts through this program. So they're building their business credit. They could bypass the vendor credit through the business credit builder and get up to 150 grand as a startup, which is pretty cool. They get money and build their business credit, and they get up to 5 business credit cards, again, creating competition. Same thing, 0% rates for 6 to 18 months, normal rates of 5 to 25% after that. Again, same thing, 8 to 12% fee. They'll need good personal credit of 700 or more, utilization under 30%, which means the limits that they have on their credit accounts, the balances are 30% or less of those limits. 4 inquiries on their credit report in the last 6 months. So this isn't as forgiving as personal cards. Sometimes they can get both personal and business cards. Sometimes they can get personal cards when they can't get business cards. We'll make that decision. Look, our goal is always to get them business cards first. That's our goal. We want to get this person business cards. If our source says we can't get them business cards, then we'll revert and ask the customer if they want personal cards. Or sometimes they want more money. We can get them personal and business cards and get them more money. But we always try to go with business cards before personal cards. Works even as a startup and pays you about 2 to 3 points, which is awesomely cool. Okay. So that being said, guys, look, this is a great program. I'm looking through a text, as a matter of fact, for one of my customers, and they actually had just come in and got $77,000 in unsecured financing. So I'll give you a little, I'm trying to look and see where she actually confirmed and read off that exact text to you. But needless to say, they were really freaking out. So I'll tell you exactly how this went down. I'm trying to look and see if I can figure out exactly what she said, but anyway, she came in and said, okay, so anyways, so what happened? Friend of mine, they're 2 doctors, they're opening a new business. They needed money for payroll. They needed money to buy equipment. So what we did was we got them $77,000 in unsecured financing, and then we helped them use the unsecured financing as the down payment on the equipment. So we got them the financing on the equipment. They needed first and last month's down payment. We used the credit cards to pay their first and last, and they still have tons of money they could use to pay payroll or any other purpose. Really ecstatic, because as a startup, they got almost $80,000 in funding, and they got the money they needed for equipment financing. That's the beauty of being able to offer multiple programs to your customers, and there's more and more of those type of scenarios we're seeing. So collateral financing, any type of viable. So think about it. We've talked through 2 of the C's, cash flow and credit. Now we talk about the third one, which is collateral, which we've had some new developments as well. Any type of viable business collateral will typically work. Some types of personal collateral will work as well. Something I don't have listed here, which I'll address before I get in, is we have a revenue lender that will now use a home as collateral if the person doesn't typically qualify. So we had a deal go in, the customer couldn't get approved for revenue lending, even at the worst and the hardest of hard money lenders. And so they had a house, and this lender allows them to use the house as collateral and then come in and get revenue lending when they normally are so high risk that they wouldn't be able to get financing elsewhere. So this is crazy. The last time I did a webinar where we talked about our funding program, we had none of the access to these kind of off the wall scenarios. And now we're bringing them in bulk with our new systems that we're developing with mass intake of lenders. So we're bringing in lenders and categorizing them in a way that we've never been able to do before. And soon we will pump this all into our technology where we'll auto determine all these things without even a manual review, which is sick. But it just gives us the ability to do so many more of these type of deals that just can't get done elsewhere. So business collateral that might work: account receivables, purchase orders, book of business if you're an insurance insurance agent, equipment, inventory, commercial real estate. This is new. Possible commercial vehicles. So I'm going to show you some of that here in a minute when we get to that. Actually, I might show you some of that stuff right now. I showed you some of that stuff on the last webinar that we did. But for example, we've got a bunch of new financing that we're now able to do on actual vehicles. So we had a guy come in, and they had an ESPN truck, which was really hard to get done. Nobody would touch it. And then we've got this new lender that deals with possible commercial vehicles and lets us look and get financing on a lot of commercial vehicles, which we normally wouldn't have. So here's a look at some of these requirements, for example. So now we're looking at trucking companies, which we've always been able to do. I'm trying to figure out how to get back to where my hangout is. Here it is right here. So for example, we talked about some of this last week. Look, 640 credit score. This person can get the money they need to purchase a truck. A long haul, if they're a trucking company, they can get money with a 640 credit score to now purchase trucks, which is awesome. We've even got financing here, even as a startup program, where they can get some financing, where they can get emergency vehicle financing, work trucks, fleets, tow trucks. Guys, we've never had this before. I've told you before that vehicles are depreciating assets, so they're very hard to get financing on. So we've looked high and low, and we've now got, as an example of one lender that we're adding back in, we've now got the ability to get people financing against tow trucks and emergency vehicles and 18-wheelers. How big of a deal is this? Well, I can tell you that when we look at our end customer, one of the top 10 industries that we deal with is the trucking industry. Makes sense. They get high limit business credit cards at almost every major gas station. That's why truckers love business credit. But now we can help get these guys financing to buy tow trucks and work trucks and emergency vehicles. This is a really, 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 really big deal, and one example of the type of financing that we're looking at. So guys, if you have it, we used to in the past kind of say, no, look, that doesn't fit our guidelines, Now we're like, bring it on, send it in, let us look at it. We've got the finance officers, we've got 3 processors, we've got 3 finance officers. We've got so much help now that we have the ability to come in and be able to help you at a level we've never been able to help, and research and bring in more of these lenders to do more of these off the top wall type of deals, which just quite honestly, we never was able to do before. So that again is pretty cool at the ability for us to start doing vehicles in some cases as well. And they can also have personal collateral, stocks, bonds, other kind of securities, 401ks, IRAs as well. So receivables, account receivables, when we talk about that, receivables are used as collateral. Loan amounts of $5,000 to $20 million. They get about 80% of the receivables advanced within 24 hours. And they're only going to pay about a 1.25% to 3% discount. A 4% fee is pretty common on these deals. The credit does not matter. Neither does cash flow on these deals. Okay. Receivables must come from another business or a government agency. Business must be open for at least 1 year to qualify. And medical receivables can qualify construction and just other receivables that are outside of those two. Although with medical receivables, they need a lot more, about $600,000. And this could pay you money recurring. You don't get rich. We don't get rich on these deals, but they pay money every single month, which is cool. So let's talk about this. I will give you an example. One of my buddies is a doctor. He's a podiatrist. I don't know why you'd ever want to be a podiatrist or choose that if you're going to be a doctor, but I've got to ask him that at some point because I know a bunch of podiatrists. Anyways, my mind rambles, so let's get back. So he is a doctor, and he deals with insurance companies, Medicare, Medicaid, and sometimes waits months to get paid. Well, what we did is we're helping him with account receivable financing, where instead of him waiting months to get paid, now he gets paid 80% of the money. So let me go back here. So he gets 80% of the money advanced to him the next day. So when he submits and says, I got this $200 bill that I'm sending to Medicare, then instead of him waiting 3 months to get $200, now what happens is he gets 160 of that 200 put in his bank account the next day. The lender collects from Medicare, right? And then they take the fee, their 1.25% to 3% fee, out of the remaining 20%. So they take the fee out of that 20% and then advance him the difference when he gets paid. So think about what this means to him. He usually has to wait months to get paid on a lot of his patients. So what a lot of doctors do is they won't accept Medicare, Medicaid, or health insurance because of the headaches of having to try to get paid. Well, now they don't have to worry about that. Now, not only will they get 80% of their money the next day, but the lender collects. The lender calls Medicare. The lender collects Medicaid. The lender calls the insurance company. The lender chases and gets the money. And then when they get the money, they subtract their 1.25% to 3% typical fee from what remains, and they give the person the balance. So it's cheaper for them than processing a credit card now, and the lender collects the money for them. Really cool. The receivables just have to be from another business or a government. It can't be from an individual. So if you're a credit repair company, you can't use this because your customers are consumers. But if you're in dealing with a business or government, you very well can use AR financing to be able to borrow against the receivables you have. And again, credit and cash flow doesn't matter. Purchase order financing, if they have $5,000 or more in purchase orders, we can get them up to 95% of that purchase order amount lent to them at a full 1 to 4% rate. No credit score cash flow requirements, and a letter of credit is issued initially and cannot be unfurnished goods. So I always use the same example here where I have a t-shirt manufacturing company that embroiders t-shirts, and they get this huge order for t-shirts that they need embroidered, but they would have to spend their own money to go to their supplier to get the shirts, embroider them, get them to the company, and wait to get paid. Well, with purchase order financing, they could get the money. They could go to the supplier. Instead of paying the money to the supplier for the shirts, the lender writes a letter of credit to the supplier and says, I'm going to pay you. As soon as these shirts are on the boat on their way over here from China, we are going to release funds to you. They get proof that the shirts are on their way. They release funds. So now the lender has paid the supplier. The customer gets the shirts, embroiders them, delivers them to the customer, and then when the customer pays the bill, which of course, again, the purchase order lender chases the money, then the customer actually gets the rest. So that's exactly how this works. So it's a pretty cool program, but they can get 95% of their actual purchase orders advanced to them. Okay, and again, these type of deals pay you 0.5% to 1%. We typically are only going to make 1 to 2% on these type of deals. Book of business financing. So commissions from a book of business service collateral from an insurance agency. So remember, so what do we talk about here? Well, let's say an insurance agent, and I got tons of friends in the insurance world. So one of my buddies, for example, owns his own insurance agency. And every year when I renew my auto insurance, I don't, do anything. It just auto renews. Well, that's really a book of business. So he's got a book of business from all kinds of people like me that just renew our auto and our life and don't think anything about it. Well, he could borrow against that book of business and use that book of business as collateral to get really good financing. He gets about a 3 to 10 year term loan. I have a standing desk, so I'm done sitting. So I'm going to stand. So if you hear this weird noise, it's my desk going up right now. So he can get a 3 to 10 year loan. That's a long-term loan. This is probably one of the best loans I've ever seen alternative outside of SBA, 4 to 9% plus the prime rate. So still fairly low interest or low rates, 520 FICO or higher. They really like to see 640, 650 credit scores. But if somebody can get approved, even if they have really challenged credit with this, and somebody can get as much as 120% of the surrender value. What's the surrender value? Well, the surrender value means if I was going to shut down my Geico agency and sell all my book of business back to Geico, I would be surrendering that book of business, and that's given a value, and it's different for every insurance company. I could get 120% of that surrender value. Look, this is the only program I've seen in my lifetime, and I've spent 17 now going on 18 years in the finance world. I've dealt with commercial loans. I've dealt with personal loans. I owned a mortgage company. And I can tell you this is the only kind of financing I've ever seen that the majority of people do not accept all the amount that they're approved for. Because in most lending, everybody wants more than they can get. With this, like somebody's like, I want 50 grand. And we're like, we can get you 350. And they're like, no, I'll take like 75. So very few cases. I don't think I've seen one case where somebody's actually accepted the full amount we can get them. We can usually get them way more than they think they can even qualify for or even want. And again, you can use the book of business for an existing insurance agency to be able to get the money to purchase that agency. Pretty cool. I talked to a buddy of mine. He's going to buy an insurance agency. I said, dude, I could get you money using that insurance agency's book of business to buy the agency. So a lot of this is used. So let's say you have an insurance agency client that wants to buy another insurance agent. Well, they could do so and use that other agent's book of business as collateral. Is this going to be available again? Is Paul's question. Yeah, it's all webinars are always available. Usually the next day after the live webinar, and they are available in your back office in the live training section, or right on your homepage is the most recent webinar. So this will be available as soon as tomorrow. No State Farm agents, because they don't actually own their book of business, but all other agencies can work, and 0.5% to 1% on direct funding you can earn. Equipment financing, just had a big meeting on this. Existing equipment or new equipment that they want to purchase can be used. Financing and leasing, if they've been in business 1 year or more, they can get leasing. 2 years or more, they get the best kind of financing. But even a startup business, as I just told you, my doctor friend, they just started their business. They can get equipment financing, but not leasing. Leasing just usually gives better payments. $10,000 to $2 million. We even have a high limit equipment financing, which goes up to 20 million, 12 to 48 months, really good terms, 5 to 55% rate. I mean, all over the board. Because when you see big rate ranges like this, 5 to 55%, what it means is they have really good financing for people with good credit and low risk. They still have financing for people with bad credit to high risk. So it's a good thing for us, because what it means is people with really good credit and really low risk get really good deals, and people that normally couldn't get financing, we could still help. They're just going to obviously pay more because their risk is much higher. A 580 or credit score is higher, typically 650 preferred for equipment financing, and 650 for leasing. 2 years in business required for actual leasing. Even a startup can get financing. If they can also borrow against equipment they already own, and they can get 50% of the value of that equipment. This is called equipment sale leaseback. So here's how it works. I got this little truck here with $4 signs on the back, which, by the way, is a radically awesome truck, whatever color that is, because I'm colorblind. I love it. Okay, so here's the deal. So this truck we own, well, the truck's a bad example. Let's say we own a backhoe, and the backhoe is less than 10 years old, and the backhoe is worth $1 million. Well, if I own that backhoe free and clear, I could use that backhoe as collateral, and I could get up to $500,000 lent to me. So what happens is it's called equipment sale leaseback, because the lender buys the equipment from me and then leases it back to me. So they basically give me the money, the $500,000 that I need, and then I make payments on it to them. And once it's paid, then I own my equipment back. Again, so that's how equipment sale leaseback works. I sell them the equipment, they lease it back to me. Startups can get financing for initial equipment purchase. You can get paid 1 to 3 points. Again, radically depends on the deal. These can actually be pretty lucrative for you and really helpful for your customer. Equipment, unsecured financing and revenue lending, by far the biggest payouts. Equipment financing is probably second or third when it comes to big payouts. So anybody you have that might need equipment, we could do. Now, I've typically said vehicles aren't equipment, but again, we now have some programs where we can lend on vehicles. Now, don't go to Dex and Dave and Jesse and all of our FOs and go, Tyson, you guys could do every single tow truck. Guys, we're just testing the waters on some of this stuff. We don't know what's going to stick and what's not going to. The stuff that sticks, we'll put on your funding program cheat sheet. Right now, we're just testing all different kinds of stuff. And when we get it to the end and we see that they actually fund a lot of these deals, not just 1 or 2, but we can fund them consistently, then we add them and we actually announce them as a core product. But still, we're having some success, just not enough deals yet to say this is going to definitely work long-term and add it to our list. Inventory financing, $250,000 to $500,000. Revolving line of credit, no credit requirements and no cash flow requirements, and they can get a line of credit, which is awesome. 2 to 5% rates, 520 credit score or higher. They don't even really care about credit. You can have somebody with lower than a 500 and still get approved for this. They've got to have about $500,000 in inventory to qualify, because loan amounts are 50% of the inventory amount. There's only one source in the country that does these kind of deals. And I talked to the owner the other day. He's a really nice guy. So with this, somebody can come in that's got $500,000 in inventory and get a $250,000 credit line. So let's say it's a big retailer. Let's say it's a manufacturer with inventory on the shelves. Any of those type of scenarios would absolutely work. Good inventory management system. They have to be able to verify the amount of inventory they have, the value of the inventory, and all they would really need is an application list of inventory to get approved. Can pay you as a direct funding customer 0.5% to 1% if you're part of our direct funding program. And again, if you're not part of direct funding and you don't know how to earn money on funding deals, then just email us, dave@creditsuite.com. Dave is handling a lot of new people that are coming in that are wanting to earn money on direct funding programs right now. now. Securities, up to 90% of whatever stocks they own or bonds, they can get a 5-year loan or a credit line. They still get interest. They still earn all the interest they would normally earn. They don't have to sell their stocks, so they still get every advantage of owning those stocks and get a pretty good rate, usually 2% plus prime, so about a 4 to 6% rate. I say 500 FICO, but there's really no credit score requirements here. Almost all stocks and securities are accepted, and all they really need is an application application copy of a stock statement. So look, it's real simple. If you've got somebody that is qualifying for revenue lending, we need 6 months worth of their bank statements when you submit the deal. If it's like the alternative SBA, we need their tax returns as well when you submit the deal. If it's any kind of collateral-based financing, we basically need proof of the collateral. So in this case, the collateral is stocks, it's securities, it's stocks or bonds. So we need a stock statement showing the value of those stocks, for example. If it's unsecured financing, we need credit monitoring login credentials. If you get those one thing from your customer, then we can help you get the deal submitted with the customer's application, give them an idea of what I'm telling you here of what kind of financing they may get, and then woof, we're off to the races. Our finance officers will take the call from that point, handle it, and they'll update you in the back office. As you saw last week, you'll be able to track the commissions that you're earning, the funding stage that it's in, see all the notes on our team in real time. It's crazy the amount of access that you have to be able to see this. So commercial real estate, 75 million to 20 or 75,000 to 20 million. Loan to values 55 to 65%. 2 years financials, tax returns, P&L, and debt schedule is what's needed. Business must have cash flow to make payments. Their bank statements, tax returns must reflect they have enough money to pay the bill. Kind of common sense. Mid credit score, 650 credit score, about average. Personal guarantee pledged assets are required. They've got to personally guarantee this, and about a 4 to 5% interest rate, which is pretty low. We just have a deal right now we're working where the guy owns a strip mall, right? It's a really interesting scenario. He owns a strip mall, and what's happened is all of a sudden he brought in a tenant where the tenant's a medical marijuana company. So because a medical marijuana company is there, the person that handles their financing radically jacked up their interest rates. I don't know why, but regardless, they did. And so what has happened is they've come to us and they're like, dude, I need somebody that could give me good terms on a commercial real estate deal where I've got a tenant where they're in the pot industry. And so we found a source today that could do that, and we're moving forward with that deal with our new system of being able to bring in lenders of these off-the-wall type of scenarios. So a lot of stuff that we're doing in commercial real estate that we've never actually been able to do before. And again, it goes all the way up to 20 million. But actually this is $500,000. We can actually go from 75,000 to 20 million, and that could pay you 0.5% to 1% on these deals as well. I already went up to, okay, so this is not right. Okay, so they can get up to 100% of what's in their 401k or IRA as well. 5-year loan. Prime plus 2%, which is pretty low. No credit score requirements. They're going to pay a fee of $19.95, but it's rolled into the deal. They don't pay any money out of pocket. The lender on these deals will charge about $2,000 in fee. No penalties for rollover. It could pay you 0.5% to 1%. So let me give you an example of how this could work for you. Let's say that you want to start a business, and let's say that your buddy has a 401k or has stocks or has good credit, or let's say a family member does, your dad, your mom, your brother, your sister, or let's say somebody that wants to go into business with you, or let's say somebody that's interested in what you're doing and doesn't want to be involved but still wants to earn a return. Any of those type of people could provide their credit and be a personal guarantor to get you unsecured financing, even as a startup. They could supply their 401k, and you could get up to 100% of the value of what's in their 401k. They can supply their stocks and bonds, and you could get up to 90% of what's in their stocks and bonds. They still earn the same interest on the stocks, bonds, and 401ks they would. They get the same returns as they would. They're just using that as collateral in case the loan actually defaults. So whether it's you or someone you know that maybe be an investor in your company of some sort, it's a pretty cool option for you as well. And then, of course, there's business credit, right? You have customers that don't have cash flow credit or collateral. Well, then that's when business credit is the catch-all. That's the beautiful thing about business credit, because they get immediate vendor credit accounts, high limit revolving store credit accounts, fleet credit accounts, vendor accounts. They don't have to provide a personal guarantee or personal credit check. They don't need financials. They don't need bank statements. None of that stuff is reviewed. Startups can get business credit. Cash credit's also available, but sometimes requires a personal guarantee, but they don't even get there anyways for 4 to 6 months. Business reports only to the business credit reporting agencies. Utilization doesn't affect their personal credit scores, right? There's no personal credit inquiries on the credit report. And it also determines what they're going to get on loans anyways. So look, you've got two types of people: somebody that can't get a business loan, and this is why you offer them business credit, because it's the only way they can get money, and they get a lot of money through business credit. Or somebody that can get a business loan and they need business credit, because if they don't have good business credit, it's going to adversely affect the rates they're going to pay on their loan. So this is why you need to sell business credit to both. If you bring the guy in that gets loan, we've got a commitment letter, which if you go to creditsuite.com/resources, I put it on the resources page from last week's webinar. You can go and get a commitment letter, have them sign the commitment letter that once they get financing, they agree to buy the finance suite from you. And then all of a sudden you get them 50 grand and they give you 2,500 to buy the finance suite after. You get paid on the 50 grand. So in that case, you make 1,500 bucks on the 50 grand in funding fee. And then on top of it, you sell business credit as well. So again, if people can't get financing, business credit's a catch-all. It's the only way they can get money when they can't get a loan. But if they can get a loan, well, business credit's crucial because it determines the rates and terms they're going to pay. So it's more of a long-term, short-term approach. Let me get you the money you can get now, but let me get you business credit as well, because your rates are going to suck indefinitely on the loans you get unless you build your business credit. So because it determines everything to do with what they're going to get for their actual bank account. So that being said, I'm going to wrap this up even a little bit early here and answer any questions that you have. And that actually goes through it. So let me go back to the 3 C's of lending, because I think that's the most important thing everybody should know, because this determines if somebody can get financing or not. So you have to remember the key thing here is to see, does somebody have cash flow, credit, or collateral? The 3 C's. If they have one of the 3 C's, and they can get one of these different types of financing that we talked about today, right? So do they have cash flow, credit, or collateral? If they have cash flow, we can get them fast, easy money, revenue financing. Credit doesn't matter. Collateral doesn't matter. If they happen to do have good credit and tax returns, or some variant, maybe average credit and tax returns, or good tax return, good tax returns, average credit, or maybe good credit, average tax returns, then there's a good possibility that we can also get them SBA, alternative SBA, private money loans as well. If the second C they have is credit, well, then we can get them that unsecured financing. We can get them 0% rates for 6 to 18 months, even as startups. We can get them 5 times the amount of money they'd ever get on their own. We get them accounts that report to the business credit reporting agencies. So that gives them business credit scores that are positive, which then helps them get even more money once their business credit's established. And again, pretty cool program. Even as a startup, they get 5x, 5 times the amount of their highest credit limit account. And again, a guarantor works. So even if they don't have good credit, they have a friend, a family member, somebody that's a member of their business that does have good credit, they can use them as a guarantor. Usually they have the person added as like an officer or something to do with the business as part of the process. They've got to be put onto the business papers at least temporarily while the cards are going through. And again, the actual funding source will help with all aspects of that. So if they have cash flow, they get financing, fast, easy money, no credit requirements, no collateral requirements. If they do have good personal credit, they can get financing. The 0% financing is a no-doc program, so there's no income verification with bank statements or with tax returns, and they don't need collateral if they have credit. Or we come into the 3rd C, which is they have collateral. And with collateral, they can, again, get all different types of low-rate financing. Financing that's lower than SBA rates, and they don't need credit, they don't need cash flow to get it. All they need is collateral, and there's new collateral we're talking about, even vehicles that we're entertaining and looking at now, as well as all other different types of business collateral and even some personal collateral, which we talked about as well. The 3 C's of lending. Does your customer have one of these 3? If they do, well, then get involved in our direct funding program, okay? Talk to, Dave for one, Dave at creditsuite.com, and talk about getting involved in direct funding, or tell them you need help. And again, Jesse, Dex, Dave, now we've got the team to be able to come in, help work with you on who qualifies, who doesn't, et cetera. But also don't forget, you've got all this available in your back office. You've got a finance blueprint qualifier in your back office. So if you go to your back office at suitelogin.com, and then at Suite Login, you go to it to add new client, well, then right there, you're going to find your finance blueprint qualifier, and you can easily add a customer. This is what that looks like. So you log into your back office, you go here to add clients, and you click, and it gives you two options. Do you want to sell a finance suite customer or a finance qualifier? Enter this info. It's that simple. You enter the info. Once you enter this info, it's called an FBQ, a finance blueprint qualifier. Then the FBQ goes right to our finance officers, and the finance officers will then promptly call you back to talk to you about the different types of financing that you can qualify if you select that you want to be talked to first, me, the partner, or they'll call your customer direct and talk to your customer about the type of financing they can get if you select client, either or. So if your customer has cash flow credit or collateral, or is close on some of these things and you're not sure if they may qualify, submit them through here, submit an FBQ, and we'll take a look at it and see what we can do. And by the way, just so you know, we're in the final review stage of our new FBQ. It's going to roll out. I'm not going to tell you when, but I'll tell you sometime by the end of January. It should happen much sooner than that, though. And this new FBQ is even faster and simpler than this. It's going to ask you basic qualifying questions, maybe 2 or 3, and then it's going to tell you, boom, yes or no, they're preliminary qualify. And then you can even move forward deeper into the qualification to get more specifics. So this way, within seconds, you'll know if somebody qualifies. And if you want to know more, you enter more info to get more detail. Right now, the FBQ asks more questions because you get a lot more detail about the type of funding that your customers can actually qualify for. But it's super simple. You just come in, add clients, boom, add client, finance qualifier. You enter the info, and then you basically leave a good note on the next page. It asks for synopsis. This guy's looking to buy a tractor, and the tractor costs $20,000, and I think he can get approved because Ty said that 3 C's, and he's got revenue of $150,000 a year, and just type that in. Give the finance officer details, and then they'll get in touch with either you or the client, whichever you select. And again, they'll handle all aspects of the deal, and you get paid, which is pretty cool. So, hey, Charlton, what's up? Welcome. So any questions you have, go ahead and get them typed in on the webinar, or go ahead and get them typed into the chat. I want to make sure that I get any and all of your questions answered. Other than that, I'll get it wrapped up. So next week, we're going to dive into business credit benefits. I'm going to map out the benefits that you and your customers should know about business credit so you could do a better job of selling business credit into 2017. And you really should spend some time over the holiday weekend thinking about direct funding, thinking about customers you may know, where to talk to people that may be interested in getting money. Because if there's anybody in your circle you know, these are the easiest people to go, hey, man, how's your business doing? Oh, it's going great. Okay, cool. Hey, look, I got this awesome way to be able to get people all different kinds of financing. Are you interested in getting a cash influx into your business? Yeah, I'm interested. Well, cool. Let's sit down. I've got like a 3-minute form I need to fill out just to get your info to find out all the qualifications or all the money you can get approved for, and then we can go. And then you sit down, you fill out this form, you have all the info, and then just get their income docs. If it's revenue lending, get bank statements. If they have good credit, get their credit monitoring login. If they have collateral, get a statement of their collateral, a stock certificate or a stock statement, for example, and then submit that in. Once you go through this process, it gives you an option of hitting save and continue, and there's a link where you can easily upload it as you go through the FBQ. And again, last week, we actually walked through that process, so you can check out last week's webinar. So if you have any other questions, go ahead and type them in. I want to make sure they get answered. Anthony, what's up, man? Can we help a client get a judgment off their business credit report? With that said, can we enroll a client with something like that on their business credit report? Yeah, absolutely you can. You absolutely can do that. There's 2 things you should know. First of all, as part of our business credit building process, we have a way to fix credit. So if we go in here to step 2, okay? So let's see. Let's take a random guess here. Step 2. No. Step 2 is not. Step 2 is not right. Do not go into step 2, Anthony. What I meant to say was you go into step 4.7, and you can fix inaccuracies right here. Do your established business credit reports list correct business information? No, they don't. I'm liars. And then you go right here to the 3 credit reporting agencies, and your customers can dispute the account right from here. Now, typically, Anthony, I've found that about 80 to 90% of accounts that are disputed get deleted, but I don't have much experience with judgments to give you stats. I can't give you an idea of that type of thing. But what's cool is that what you can do is you can build new business credit, and this is somebody that definitely wants to do so to offset the damage of the actual negative account, okay? So that is another option that you have. So let me see here. I'm going to try to get in, and I'll show you a real example of what this looks like. I'm gonna have to reset my password, so I'm doing that right now, and I will give you an example of what this looks like. So the bottom line is that somebody that comes in and somebody that has better credit Engage, please fill your information again. Current password. Okay, I got to get back to you on a different day because I have to log in. I was going to show you an Experian report that actually shows this, where the guy has a $10,000 judgment and he still has a 97 score because he built a bunch of vendor accounts as trade lines. The vendor accounts offset his positive, and he's still got a 97 business credit score and being recommended for $34,000 in credit, 34.4, even with a $10,000 negative collection. So yes, it absolutely can be done. I wish I could show you an example, but it's making me update my login info, and I'm not sure what my existing password is, so I'm not able to do that right now. But yes, it absolutely can be done. As a matter of fact, the only way this guy can help fix his credit is to get new positive accounts that'll offset the negative. And since things like Paydex score are based on payment history, then all they have to really do is come in and get a lot of good vendor accounts, and that'll offset the negative. And like I said, I've got a guy that's got less than 10 accounts. Most of them are vendors, and he's a 97 score with a $10,000 collection. And his highest trade after that's like $4,000. So that's an example of that. After adding client and they are declined, will the payment be refunded? What do you mean, Paul? I don't understand what payment you're talking about. You'd have to give me some more info. So you're saying, okay, I have a question about adding a client and they're declined. So you add a client in here for financing. Will the payment be refunded? Well, we didn't take a payment from your customer for that. And if you're a partner with us now, which if you're on this webinar, you obviously are, then you can email Dave@creditsuite.com and he can get you into the funding program, especially through January, on something we have without any payment being subtracted from you. So again, now if you're selling a finance suite, you should never be selling a finance suite based on the premise that somebody definitely is going to get business credit. That's always problematic because there's so many variables of getting a business loan. We can't guarantee if somebody is or isn't going to get a business loan. So the bottom line is that you should never sell a finance suite based on the premise that somebody is going to get money. If they're only going to buy the finance suite, if they get money, then bring them in for direct funding first. Bring them in. Let's get the money. Have them sign the document in that states that they absolutely will buy, which is available here in your Credit Suite Direct Funding training. And then in doing so, you could basically get them funding. Then they come in and buy the finance suite after, but never sell a finance suite based on the premise that you're going to get a funding, because we don't know if it's going to happen or not until they go through the process from the partner. And I hope that answers your question. Paul, if it doesn't answer your question, then recite it. But I gave a bunch of different scenarios based on variance of what your question may mean. So I think I covered it. If not, let me know. Charlton, can I get a client direct funding that owns a hotel and the land, but the hotel is closed right now due to repairs? Sure, let's look at it and see. You know, what you taught. There's a lot of questions here. Does the guy have good credit? Could he get unsecured financing? He probably can't get revenue lending because the hotel is closed. But if he owns the location, the building and the land, that's a commercial real estate deal. So we have to look at it. One of the requirements for commercial real estate is that they have to be showing enough money in the business to pay the payment. So that's one thing of concern, is can this guy even afford a loan payment if his hotel's not generating revenue? That's something that would have to be reflected on probably tax returns or financial statements that we're going to get. But it is a potential commercial real estate deal, not an easy one, because the commercial real estate isn't generating revenue right now. But again, if a deal makes sense and the guy can prove that he's got the method to pay back the loan, then absolutely it's something we could definitely take a look at and see what we can do. Anthony, so they can enroll even if they have a blemish and open new business? Yes, absolutely they can. They absolutely can, because a lot of vendors won't make their initial approval decision based on actual business credit quality. So a lot of them will just give you a line of credit without even really paying much attention to the actual business credit quality. So because of that, it's absolutely possible for somebody to do, but they should dispute it, as we show you in step 4.7. And then they also should focus on getting a bunch of vendor accounts, as many as they can get in step 3 when they start getting vendor accounts. Yes, you did. Thanks, Coach. You got it, Paul. Hopefully that helps you. Okay, thanks, Charlton. Okay, so I don't have any other questions. I'm going to go ahead and wrap this up. So remember, all it takes for a customer to really qualify for financing is cash flow credit or collateral. If you think they're borderline, if you don't know, then get whatever income docs we talked about. Get that finance blueprint qualifier filled out. Do not do that Do not come in and have them fill it out. You do it with them on the phone, get it submitted with their income docs, and let us take a look. We'll take a look and see what we can do. I'm trying to look and see if I can so that's exactly what you want to do is you want to get them submitted here in the Finance Blueprint Qualifier. We'll take a look and we'll get an idea of what they may be able to get. And don't forget that as part of the direct funding program as well, you get this really cool Credit Suite direct funding training. And this is a 3-step training which teaches you about rates and terms and fees and more on the loan programs that are available. And it answers just about every question you can imagine, how the loan process works, how long it takes you to get paid. All that training we go through in this direct funding training. So if you're going to submit deals for direct funding, I recommend going through it. It doesn't take a lot of time. There's only 3 steps, and this will get you a ton of answers that'll make it easier for you to get these customers submitted. Shimon, thank you. I appreciate you coming. And Ardeen, thank you. I'm glad this is great info. So if you have any other questions, go ahead and let us know. You can easily just email our team right now. Just probably email Dave at creditsuite.com. He's really not going to appreciate me giving out his email as much as I am, but that is okay. That's what he's going to be doing. So, and Dave is on the West Coast. We've got a team here on the East Coast in Florida. And we got our West Coast team. A lot of them are in Washington. So this way we can represent people in all time zones. So just get us with us. Let us know. If you have any questions on submitting deals that might qualify, those type of things, let us know. But the easiest things, just fill out the Finance Blueprint Qualifier and get the income docs and send them in. And then our team will get on the phone, look through them, talk with you, talk with the customer, and you can see what you could really get done. But if you have real quick questions, then let us know. You can also go to our support team, support@creditsuite.com. Support@creditsuite.com is another way you can have those questions answered. Let me see if I have any other questions. Could a client who owns 7 residential rental properties get direct funding? Sure. Let me see, man. Well, they own 7 different residential rental properties. So that's really going to be it's really, they could get the money they needed, Matt, I'll call Matthew. I don't know if you go by Matt or not. So Matthew, they could get the money they needed to do fix and flips. We've got hard money deals if they've got a history of fixing and flipping. But if they want to borrow against residential property, that's a mortgage. That's literally the definition of a mortgage, is using property as collateral for debt. So you're describing a residential real estate mortgage deal. They would probably go and get a residential mortgage, cash out refi on that deal. But if they want to get money to buy residential property and fix and flip, and they've got some experience in that, we can definitely do that type of financing. So hopefully that helps. And if they have revenue from rentals, then we might be able to do something. So maybe get unsecured if they have good credit, maybe get revenue lending if they have revenue. Can we use the residential individual properties as collateral? Probably not, because they actually would need a residential mortgage for that. More than likely. It would be different if it was commercial real estate, though. Let's kick it. 2017. I'm all in. Good, Anthony. Hopefully when your guy gets back from the Bahamas, we can get that deal funded. But we did get the deal approved, so we're just waiting on him. So when he gets back, make sure we get that wrapped up. And anything we can do to help you as you get up and going, Anthony, let me know, because I know you got a lot of stuff working, and you're going to make a lot of money on direct funding this year, which is cool. I'm in Orlando all week long. Shimon, welcome to our world. How do you like the weather down here? It's flipping beautiful, right? It's like 80s all week this week. I wish I could see you, but I will refuse to go to Orlando this time of year. I went to Orlando when my parents and my niece came down one year, and at 10 o'clock a.m. they closed Disney because Disney was full at 10 a.m. in the morning. You could not even walk, and I think we were the only people there that spoke English. So we went back to the hotel room and we hung out in the pool. So I have learned my lesson. My family goes over to Disney all the time because we're an hour and a half away, but we absolutely will not go over into that neck of the woods this time of year. Otherwise, I would come over and see you, which would be cool. But enjoy yourself over there. It's a lot of fun, and the weather is beautiful down here. So I hope you have a good trip down here. So I don't have any other questions. I'm going to go ahead and wrap this up. Thanks, everybody, very much for attending today. You got a lot of good info. If you have any questions, let us know. Support@creditsuite.com. I gave you Dave's email as well if you're interested in getting direct funding. And next week, we'll be diving into business credit benefits for your customers. And in the meantime, have like a ridiculously magnificent Christmas. I hope you have an absolutely awesome Christmas. Don't forget, I think the sales expired as of last week, but some of you that still may be trailing, we do have a 30% off incentive on like anything you want to buy. Sales funnel done for you, single enrollments, prepaid enrollments. So buy yourself something nice for Christmas this year and get with our team, support@creditsuite.com. Let them know. I think we canceled the official sale the end of last week and cut 86 the promo code, but they have a backlink if you want to slide in before the holiday. It's pretty cool to be able to grab pretty much anything that we sell to you as a partner at a 30% discount, including our sales funnel done for you. So check that out as well. Any other questions? Let us know. I'm in Detroit, Charlton. I feel so bad for you. I didn't mean to. I usually don't talk about temperature this time of year because people get mad at me. Like, you're mad at me now. Don't be mad at me. It's not my fault you're in Detroit. You can move down here. If you move down here, we'll hang out. We'll do lunch. And like, I'll take you flying. I'll take you up and I'll fly and I'll show you Tampa from the air. And then we can go out sailing one day too. Like when it's warmer, like January 2nd, when it's warmer, we'll take you out sailing. So feel free to come down and at least visit us here in Florida. Just like Shimon's coming down and visiting us in Florida. So thanks everybody. Any questions you have, support@creditsuite.com. Let us know. Let's rock it. Let's have an awesome 2017. Have an unbelievable Christmas. Spend some time with your family. And if you're lucky and blessed like I am to have little kids, I hope you really enjoy it, because nothing's more exciting than watching little kids come downstairs and Santa dropped off a bunch of gifts and they go through that whole experience. And if you're not like into Christmas because of religious reasons, my bad, didn't mean to insult you. But I love Christmas. It's an awesome time of year. So enjoy Christmas with your families, everybody. Have a great year, or a great great holiday. And I will talk to you next week, the last webinar we do of the year. And again, let's rock it in 2017. We will arm you with everything you need to make a ton of money with business credit financing. And we got some really cool stuff coming up the first quarter of next year, which I'm not even going to talk to you about, but I will start talking to you more about as it gets closer, with some new things they're going to be rolling out. They're going to make it even easier for you to offer business credit, as well as all the new changes we made to make it easier for you to offer financing. Thanks, everybody. Have a great day.